let's talk about measures of profitability. The arrow pointing upwards indicates that we prefer these ratios to be as high as possible. Now, generally they are expressed in percentage units. Okay, let's make it easier for you to see that. Change ink. And let me give you examples of three different measures of profitability, the ones that are most frequently used. First is return on assets. And what this basically tries to measure is given the money that has been provided by all providers of funds, so both equity holders and lenders, right? They provided funds, and with those funds, we're able to acquire the assets that we have. So the book value of the assets is just basically, total assets as you would see this in the balance sheet. So let's suppose that the book value of your assets equals $1,000. Right? Let's suppose that net income from your income statement amounts to say $100. So this is 100. And you have to pay interest on debt on the funds provided by lenders for a specific period of time, suppose a year, of $10, right? So what you have is really $110 divided by the $1,000. What is the return on assets? That will give you, 11%. What does that really mean? It means that, remember, we always use the denominator. Okay, it means that for every dollar provided by both lenders and equity holders, the company is able to generate 11% of that, so 11 cents of that dollar in the form of payments for equity holders, which will be net income, and payments for lenders, which will be interest. So the denominator tells you basically how much we've raised from these providers of funds, and the numerator tells you what we're able to pay them given our profitability. So that's the return on assets, right? 11%. That's what it means. So it's a measure of how well we're working on behalf of all providers of funds. ROE is much more specific, return on equity. It attempts to measure how well we are working on behalf of not all providers of funds, but only our equity holders, the owners of the company. So let's suppose again that we have the same net income that I mentioned before of $100. And suppose that equity holders have provided, say, half of the total capital that we use to purchase those assets. So half of that comes from equity holders, which is $500. So the return on equity in this case would be 20%. What does that mean? For every dollar provided by equity holders, we're able to generate 20 cents of a dollar, right, in the form of payments that we're going to give those providers of funds. Okay. So one measures how well we work on behalf of all providers, ROA. The other one measures how well we work on behalf of equity holders. Now, I want to introduce or remind you, if you've seen this before, return on invested capital, because this happens to be a ratio that, while it measures profitability, I'm going to show you that it's much more stable measure than the first two. So just to explain, return on invested capital says don't give me net income, because I know that net income is affected by interest payments and so on, by the way the company is funding itself. Just let's use as the numerator, right, the payment that the providers of funds receive. Let's use the operating earnings. That's why we use EBIT. And of course, we pay taxes on that. So whatever your tax rate is, you adjust. So EBIT times 1 minus the tax rate, suppose your tax rate is 25%, right? 1 minus the tax rate, that gives you the EBIT after tax. But remember, it is EBIT. It's operating earnings. It's not net income. So we take that operating earnings and divide that by all the money that has been provided by the providers of funds, which is, of course, the book value of the equity, the balance sheet, and the debt. Remember, when we talk about debt, we talk about any loan for which we have to pay interest. So it could be short-term debt or it could be long-term debt. All of that is included in this component, the net debt. Okay, so think about all the loans that have been provided to the company and for which there's an explicit interest payment expected. I'm going to argue that the ROIC is a much more cleaner and stable measure than the first two. Let me show you that using an example. Suppose that you have a company that wants to fund $180,000 of new assets, right? Now, those assets can be funded through debt and equity or only through debt. So only through equity. So the debt and equity scenario is this, right? The $180,000, I funded $142,000 coming from debt holders and $37,000 from equity holders. In the without debt scenario, the same thing, we're funding all of the money from equity holders. So if you crunch the numbers and you start with EBIT, in this case, both EBIT are the same, right? Because EBIT is earnings before interest and taxes, so there's no impact of whether you have debt or not. Doesn't affect EBIT. You start with EBIT, and if say your interest that you have to pay on your debt is 8.7%, in the first column, you subtract the interest. You get earnings before taxes. Suppose you pay a tax rate of 50% just to make it easy, and you end up with net income, right? Suppose you have a net income if you are a company, the same company with debt and without debt. Okay, so imagine the same company doing the same thing, except that in one case it has debt and in the other it does not. The net income will be $4,009 if that company funds its needs through debt and equity, or $10,200 if it funds everything through equity only. Obviously, the reason why the net income is lower in the first column is because you have to pay interest. All right, so if you crunch the ROE, ROA, and ROIC for each of these two scenarios, you'll notice that something interesting happens. Look at ROE. ROE, remember, ROE will be net income, right? So that's the 4,009, right? Just to give you one example of how we do this. Okay, divided by equity. That doesn't look very nice, so let's do it again. So we take net income of 4,009, okay, and we divide that by the equity. And the equity in this case is 37,800. All right, that's what gives you that 11%. You do the same thing for the column without debt, and you'll get 6%. So if you crunch the numbers for ROA for both of the two columns and ROIC for both of the two columns, you realize that something interesting is going on. With debt, what happens to ROE? It goes from 6% to 11%. With that, what happens to ROA? It goes from 6% to 9%. This is why debt is sometimes called leverage, because it happens to be the case that it levers profitability. In other words, it makes the company's profitability look much better. It enhances profitability. So if you think about this, what you're saying is that basically these profitability measures are measures that are affected or biased by the presence of debt. You're funding the same investments, the same machinery, the same type of projects. You're not doing anything different. It's just if you fund those projects one way or the other, so paper shuffling, right? Just shuffling papers, you can look better than not having debt at all if you have debt in your capital structure. So clearly those measures that are biased by the paper shuffling are not as transparent, as clear, right, as measures that would not be affected by that. And that's what happens to ROIC. Look, ROIC is 6% whether you have debt or whether you do not. So in that sense, ROIC is a much more stable measure. Remember, ROIC will be EBIT, which is at 20,400. Let me just, okay. ROIC will be taking the EBIT, right? And subtracting, right, the interest payment that you have to pay, right? So, but be careful now. It's subtracting, sorry, the tax that you have to pay. So it would be, just to put it here, the 20,000, right, 400 times 1 minus the 0.5. That's the tax rate, right? And you divide all that, right, by all of the funds that are provided by equity holders and lenders, which in this case is easy because in my simple example, it's the full $180,000. So, and that's for this column, of course, right? So notice that ROIC is much more stable. So of the three, the most stable measure of profitability, the ones that gives you always a consistent result without being affected by the way you're funding yourself is ROIC. The last thing I wanted to show you is called Dupont, because it's basically, this is the first company that actually used this method of decomposing ratios. Remember the ROE that we estimated in our previous example, say of 20%. Now, what happens if you say, okay, I know that my ROE is 20%, right? This year. Suppose that last year my ROE was 10%. This was last year. This is this year. What if you wanted to know what happened? I mean, you know what happened. It went from 10 to 20%, right? And you could argue that, well, if since ROE is net income over equity, it must be that you are generating, suppose, higher net income. That's fine. That's fine. But what if you want to go further? What if you want to know what were the drivers that actually made you go from 10 to 20% in this period of time? Well, what Dupont allows us to do is to decompose ROE into three different ratios, into sales over total assets, which measures how well we're using our resources. It's called asset turnover. So imagine that you have a sales of $1,000 and your total assets are, say, $10, right? What does that mean? The sales over total assets will be 10 times. 1,000 divided by 10 is 10. It means that for every dollar of total assets, you're able to convert that dollar of total assets into what? Into 10 times the number of dollars in sales. So it's how well you use your resources. That's the first ratio. Net income over equity can be decomposed into sales over total assets multiplied times net income over sales. That's your profit ratio. It tells you how well your sales are being converted into profitability, right? If your sales are $100, right, and say your net income is $5, what are you going to get? If you divide 5 divided by 100, you're going to get 5%. It means that for every dollar of sales, 5% of those dollars are converted to profitability for equity holders. So the second ratio measures how well we are, how efficient we are in generating our operations. So here we are, ROE being decomposed into asset turnover times net profit margin times total assets over equity. This ratio is a measure of how much debt we have in a capital structure, how much debt is being used in order to buy the assets that we have in the company. So the multiplication of these three ratios has the same effect as simply dividing net income by equity. If you're not sure about this, just notice that these can be canceled out, and so net income is divided by equity, right? This divided by this, which is the same thing as what we have here. But here's the interesting part. Now you can look at you going from 10% to 20%, and if you calculate Dupont for last year's 10%, and you calculate Dupont for this year's 20%, and you decompose it, you can find out which of these three drivers was the main explanation, the main cause for that increase in ROE. So this Dupont identity allows you to dig deeper into trying to understand what made you or what's affecting your profitability. Could it be that your profitability doubled? It went from 10 to 20% because, say, you were able to turn over your assets in a better way, or was it because you became more efficient in the way you were able to reduce costs so that you could get more profitability out of every dollar of sales? Or was it just basically because you just borrowed more money? This is why it's called leverage. Remember, leverage is because it increases profitability. If this goes up, it would increase ROE. So which of the three is the one that's causing your profitability to go up? I would suggest that if you're trying to assess the financial health of a company and you want to compare profitability between 2 years or 3 years, it's very nice to be able to apply Dupont to each of those so you can see which driver is affecting your profitability the most.